means that if a signal says 1% risk, means that, let's say if you have a $100 account, that when the trade hits stop loss, you only want to lose 1% of that account. So on a $100 account, it should be, your stop loss should only cost you $1. The way to calculate your risk at the beginning, because once you're getting more and more experienced, it will become easier, but in the beginning it's best to use the calculator. Let's say there is a signal which says 3% risk, and you're trading with $250. Well, like it said, 3% risk, and you are going, let's say just for example purposes, we have a long trade on a 10-time leverage. Let's say this is Bitcoin, so we're entering long at 27,650 with just one entry, so that entry is 100%. We taking profit at the trading range high, which is about 2,850 at the moment, and we put a stop loss at, let's say, 27,200. Alright, so as you can see here, it then calculates your potential loss, and as you can see, the potential loss is $7.50, and on $250, $7.50 is that 3% risk you're taking. So you have to put on entry, so you have to put on as margin $45, because it's a 10-time leverage. Your weight and the amount of the trade is $450. The potential win is $8.20, and the potential loss is $7.50. A liquidity sweep just means taking liquidity and going back in the direction of the trend. And a break of structure is actually forming, so these are two different things. A break of structure is actually forming the next lower low, lower high. So let's see, I can draw a path. So here we have low, high low, another higher low, low. Then we have here, so this is price movement. It's making a high here, then a higher high, and another higher high. So what does a break of structure mean? It just means you have a low high, makes a higher low, and then a higher high. So the trend is moving up. So we have a trend in this direction, a bullish trend. It means that a break of structure occurs when the next move up goes above and closes and forms a higher high. So it goes, how do you say it? It moves beyond the previous high. It moves beyond the previous high, it will form a break of structure. and then after the higher high, and let's say this continues but forms a lower low, you have a change of character. But a liquidity sweep is nothing more than price trying to make another high, a higher high, but failing. So it will be the same as this. You will see a move up from the higher low to the higher high, but price briefly touches the liquidity that's above the recent high, so in this block. But instead of going through that, forming a new higher high, it rejects and goes down and closes below the previous high. So if you look on the chart, you could say that this was the previous high. We had a sweep here because price tried to move past the high we've seen here, but then rejected and closed below. Yeah, I think that's a nice topic to talk about, and it also has different opinions on when an FEG is invalidated. So this is the 4-hour Bitcoin chart, and as you can see on that dump we had a while ago, FEG formed. This one not, because the wick of this first candle crosses, if you zoom in, overlaps the wick of the third candle, so no fair value gap there. But as you can see here, the first candle, bearish candle, didn't wick as low as the highest wick of the third candle, so there's a fair value gap there. So then the question, when is it filled, or when is it considered filled? I think it's personal opinions. I think everyone has different views on that, but in general the consensus is that fair value gaps most of the times get filled. And as you can see on this lower gap, it first touched the gap here when it acted as resistance, and finally on that pump we had Tuesday, it just blown through. So we have this point, and as you can see, fair value gap, this considered filled. Although it fills, it just still has value, as it could be or could act as resistance or support. As you can see, this fair value gap touched a little inside the gap and then rejected. So the question is, do you consider this filled or not? What people tend to use is the 0.5. It's called the consecutive encroachment, which is the 0.5 line, so the midline of a fair value gap. As you can see here, 0.5, and if I draw it on this fair value gap, oh, that's the wrong one. What the consensus is that when price moves up to the CE, the consequent encroachment, so the 0.5 midline of a FEG, and it rejects, that's a good spot to see a reversal or price move back and consider it filled. But I could be talking about that an hour, because views are different on that. I think what you need to do is, and that goes for everyone who's starting to trade or who is trading for a longer time, is look for the approach that fits your strategy, because if there was one strategy that would work all the time, everybody would use that eventually, and everybody would make lots of money. So strategies, FEGs, it won't work all the time. So you just have to find that strategy, or if you like to work with FEGs, you have to find a strategy working with FEGs that works most of the time. You don't have to have a strategy that's 90% effective, because that doesn't exist. Almost impossible, because market can do anything anytime. So the question is not really what's considered failed. I think the question is how you use it in your strategy, because an FEG is still an area of interest, because if there is more confluence, let's say if there are EMAs or there are order blocks, then it can also act as a resistance area or as a support area. That's debatable. People say, well, if it's three of the same color, so if you have a bearish FEG, they have to be red, because that's a better FEG, and when it's a bullish FEG, they have to be green for it to work perfectly. But nothing works perfectly. That's facts. And I'm hearing people talk. Okay, back to here. So you can say that FEGs that are in a downtrend, so 3 red candles, tend to work better, but I've not worked too much in my strategy with FEGs to tell you what I find or found best working in that case. So which coins are preferable to trade? Well, I prefer, as you can see, I have a funded account which I trade only, most of the times, only Bitcoin, gold, and Forex, Euro, USD. That's all I trade. Sometimes Ether, but that's just 4 coins with a lot of liquidity, less volatility than other coins. Then for the 180 trade challenge, I only stick to the top 50 coins, and I do that also. When I started out, I just used top 20 coins. I do that because those coins are more liquid. They have less big wicks out of nothing, because if you trade a small cap coin, there only has to be a relative small buying to make price move. So also TA will be less reliable. So when starting out, I would suggest just stick to high cap coins. So from Bitcoin up to the top 50 of coin market cap. So about divergences, just means nothing more than price moving or making a higher high, and RZ, for example, making a higher low, which basically says that buying pressure or selling pressure is minimizing, which could indicate trend or price reversal. I only use divergences on RSI, because those are most reliable, and which goes for every indicator. The higher the time frame, the more reliable indicators are, because indicators are always based on historical data. So the more it goes back, the more reliable it gets. But just take into account that is always, we always talk about probabilities. There's never a certainty when trading. When drawing out something on the map or on the chart, there's never, you can never tell for sure or for certain that something is going to happen. You always have to take into account that the opposite can happen. So like I said, what you want to see is that price is either making a higher high, it's making a high, and RSI is at the same time making a low. I'll give this as an example. You have a high here and a high there, where you see that it's still getting highs, and at the same time, give this another color, blue, and at the same time price or RSI is not as strong as it was. So so the divergence means nothing, that the price chart is showing something different than the RSI chart, which means if price moves up this much but RSI doesn't, then that says something about buying pressure, or about how much there's been bought. So buyers getting exhausted, and usually when that happens, what you see is that when a bearish divergence, in this case, starts to arise, you will see a downtrend, or at least price coming down for a fair bit. So what you should take into consideration, or how to memorize it the best, is for a bearish divergence. I will not go into hidden or nothing, but for a bearish divergence, you always look at the highs. So you draw a trend line from high to high, and on the RSI also from high to high. And if that diverges, that means you're having a bearish divergence. For a bullish divergence, you're looking at the lows. So then there has to be, you draw lines from low to low to see if the low is making a lower low and the price making a higher low. So as you can see here, we had a low to a low, and if you go, so always make sure you're drawing from the same point. So you go down and you draw from the same low to the low, and then you see here price made a lower low, but the RSI made a higher low, which means sellers got exhausted. They weren't as strong anymore, and what you see usually is that follows what follows is an uptrend or a move up. Divergences are good for added confluence, so just don't trade only the divergence, but use it as confirmation for your trade idea. Use it as like I said, added confluence. If you would be here and this is a local low, or there is a golden pocket, or there are EMAs in this area, would possibly have a good point for a long. You determine tops and bottoms. Use either local lows and local highs, or swing lows or swing highs. So if you are watching a higher time frame chart, what you then do is that you look for, let's have the Bitcoin chart, it's better. So what Fibonacci does is it helps you either to see or to predict, which isn't always a guarantee, but it's a prediction tool which can possibly tell you where a price either retraces after an up move or where a price should move up to after a down move. So basically what you do is you look at a move up or a move down and you wait till it's either topped out or bottomed out. So let's say we had the recent move down, so that's this move from here to there. That was the down move. So when a move down happened, what you then can do is you want to know if you think this is the bottom. So for now the bottom is in, so what you then see is if bottom is in, price will move back up, and then you can use Fibonacci to tell you or give you some idea of where it might extend to. That's why you can use you can use them two ways, but officially you would use the Fibonacci extension tool, but I use Fibonacci retracement for both because they give the same outcome. What you then do is, if you want to know if price bottomed out here and the top was here, you want to know where it can possibly retrace to, then you put your top at the top, the highest high, and you put your bottom at the lowest low after the high. So for the extension you use the high before and the low after, and then let's put the all and the golden pocket. As you can see, when I zoom in, make this a little smaller. So you would use the Fibonacci extensions if you're looking for either points to take profit or go short, because if you longed here, then you wanna know where you can take profit. So the golden pocket is always an area of interest. As you can see, price has moved a lot in the golden pocket, so it's also a support area. So this could be potential price if you took a long here to take profits. Also, you'll see the EMAs 50 in this case at the 0.5. So you use this high to this low to figure out where price eventually may extend back to. That's the extension. Then you have the retracement. I think the retracement is more used, or is often used. It's more used than the extension. What you do with retracements is you want to know where price retraces to after an up move. So let's say we have here the local low, and here we have the local high. So as you can see, price bottomed out here and topped out here. For retracement, you use the low before and the high after. So you go from down to up, and for the extension you move from up to down. So if we draw this, and always in hindsight, let's put out the magnet. Drawing things and seeing things on charts in hindsight, it's always easier than live trading. But if you look at this move up from here to there, and let's collapse this plane. Okay. If you see this move up, so from down there to up there, then you see price topped out here and then retraced eventually to the 0.5, which was also the 200 EMAs. The darker of the EMAs is me using the 200 EMA. There you can see that's a point of interest. So it quickly got up below this and then it moved back up, so it bounced. It never reached the golden pocket. So in general, you use highs and lows, and you use the most yeah, I'm not sure how I say that in English, but the most spoken out highs and lows. So for example, if you see this high, you don't use this one because we have a higher high here. So then you use this one. And you don't also not use this one because this high is higher. So make sure you use the highest high in that price range or in that period and the lowest low. So hope that helps a little with trying out Fibonacci's. And also be wary or just take note of the direction of the Fibonacci. So again, if you want a retracement, you go from the low to the the next high, and if you want an extension, you go from the high to the next low. So hope that gives you a bit more confidence putting on Fibonacci's and taking that into account when you're charting for yourself. For anybody who doesn't know, I like to trade breakouts and breakdowns from trend lines. So breakdown is a break from a trend line downwards and a break out to the upside. And what I then will look for is a break through, because you see here, if I zoom in and tell you something about that, if you see here, the trend line was broken, but it closed back above. So if you would see this line break the trend line and you would go short immediately after it broke, well, then stop loss would have certainly been hit, as you can see. So what you want to see is, let's see if I can find a good example or a quick example. Well, this is a quick example, only what you see here. At that point, the trend line wasn't there, but just for education purposes, if this trend line did exist and went further and came from here, I would be looking at this as an area of interest to see if there was a breakdown. A breakdown candle means closing below the trend line, which did here. Then a confirmation candle, which means the whole candle, the second candle, is below the trend line, and then a retest of the trend line. So if I zoom in, you will see that that was exactly what happened here. Breakdown, then a close, second candle close and open below the trend line, and the third candle retested the trend line, and then the move down happened. And also this was a fake out, so if it's trying to break out but it doesn't, you call it a fake out. This is a fake out candle, but then there was a breakout candle breaking above the trend line and closing above. Then we have a candle completely above the trend line, and we have a candle retesting the trend line. Then a move up and a bit move up, and we had another retest of the trend line, and eventually we had the big move up. So although this doesn't always work, it's a trading strategy with an edge. So especially when I'm scalping lower time frames, I use this a lot because this works for me. So it doesn't necessarily mean it works for everybody, but I like to trade this strategy. There is a YouTube video I made on this strategy, so if you haven't seen that yet, just go to YouTube. On the YouTube channel here in the Discord, you can find a link to that strategy. So yeah, and that's what I'm waiting for again at this point. So I'm waiting for a breakdown candle that closes below breakdown, and then a candle that is completely below, and then I will enter on the retest of the trend line. So that's why this one is still here, and I'm not sure if I have a notification. So what I then will do is set a notification with just 2 letters, BD, in this case breakdown, which means it breaks down on the hourly. I have an hour. Still don't have to be quick or anything, because we still have an hour to see if the second candle, etc., breaks down. What also can happen in this case is deviation. We have the fake out candle. You also have a deviation. Deviation just means, and that's why I wait for the second candle to fully close, because when deviation happens, it just means that there's 2 candles. First candle closing below, but the second candle going back above or below the trend line. Let's see if I can give you an example. There's no trend line here, but I'm just going to take it as an example. So let's say there's a trend line here. We would have a breakout candle here, but the second candle breaks back down and closes below the trend line, so it's a deviation, and means the trade won't be valid. So that's why I always wait for the third candle retest to enter. So first, second candle waiting to close to be in the best situation fully above, and the third candle retesting the trend line. So guys, I'll let you know when the next one will be. Thanks for joining me, thanks for asking the questions, and I'll talk to you guys later. Thank you guys.